You have three things that you look at for the warning signs, and the first is a straight-up non-farm payroll report.
Right. So if if we pull up the graphic, you can see going back all the way to the 1970s, and we could go back further. When you see employment gains in such robust territory, it would really take an exogenous shock to tip the economy into recession. And so exogenous shock means a surge in oil prices or a geopolitical event, not the economy basically faltering under its own weight. I share the sentiment from the first video clip you had, which said that a recession will come eventually, but we're not at that point yet. I've seen some analysts saying 40 or 50% recession odds. I think it's half that much. I think we're closer to 15 or 20% recession odds. So we absolutely should be concerned when the economy is slowing down. The economy is like an aircraft. If the forward speed continues to reduce, eventually it can drop out of the sky. The scary speed is not zero for the U.S. economy. It's closer to 1.6% in year-on-year terms in GDP. And right now we're at 1.8. So we're getting close to the point where we should be concerned, but we're certainly not seeing the types of downdrafts emerging that would point to a recession looming near.
And of course, some people say that we are due for recession because on average they come, once every 7 years. When you look
worst way to measure business cycles is using a calendar. You have to look at the underlying fundamentals.
Let's look at some of the underlying fundamentals of wages and salary disbursements. When you look at a chart of that, what are you pinpointing? What level?
Right. So what we're pinpointing in this chart here, and that's not a plunge at the end, so a little hiccup at the end of the chart there, but what we see here...
Good, so not a plunge.
Exactly, so there's not a plunge there. But what's more important here, you see income growth rolling over ahead of recessions. And we're not seeing that now because we have low inflation and we have income growth that's not great, but it's decent because the labor market is decent. So as we evaluate the pressure points for the economy, what could tip us into recession? Well, let's look at the key drivers of growth going forward. Housing to a small degree, but more importantly, consumer spending. So if you want to know risks to the outlook, it's not necessarily a pullback in CapEx in the oil patch or something on the government spending front. It's things that will jeopardize consumer spending going forward. And as long as we have decent job gains, we don't have to see the near 300,000 pace of job growth that we saw in Q4. But if we're seeing 150 to 200, then that tells us that consumer spending is going to hold up at least at some base level, which will continue to propel the economy forward. So many of the curses of this cycle, sluggish growth, lack of wage pressures, extremely low interest rates, are now turning into blessings, which are extending this economic cycle. And I suspect that R word is not going to materialize realistically until potentially 2019 or 2020.
Wow.
So we've got a long way to go, which goes back to my original point. Calendar, a very bad way to measure business cycles.
And that sort of brings us to the debate of manufacturing versus services. And you brought a chart that looks at that versus GDP. And when we do get recessions, you tend to see all of them kind of plummet right at the same time, whereas that service line really holding up.
Right. All of them plummeting, but a lot further than where we are currently. So here we show GDP versus the manufacturing ISM and also the non-manufacturing or service sector ISM. They're tightly correlated. The correlation coefficients are about 65 to 70% with GDP, which is meaningful. And certainly we should be concerned that both of those ISM surveys are slowing down, but they are far from recessionary territory. To signal a recession, the manufacturing ISM would have to be closer to about 42 or 43, whereas earlier this week it came out basically in the vicinity of 48. Similarly, if we look at the service sector ISM, where it stands now, 53.5 roughly, is consistent with GDP growth of about 1.5%. So that's pointing to a significant improvement to where we were in the fourth quarter of last year, but still an economy that's just muddling along at a pace that's not going to generate many inflation pressures. And so the Fed can take a sigh of relief that they will not have to be too active this year in such a go-slow economy. They're going to have to dial back the rate tightenings that they penciled in December. I suspect half as many.
What does the job growth look like in a muddling along economy?
Well, this is the benefit of low productivity numbers. And we don't want productivity to be low forever. A lot of hand-wringing over numbers like we saw this morning with very weak productivity gains. But in the short run, low productivity growth means that we can have solid job gains in a go-slow economy. And I suspect that can continue into the current quarter. And this happens at a critical time where we need to continue to draw down slack in the labor market.